welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 16th of January 2024, and here are the questions we will be answering today. Will students warm up to foreign universities in India? How can India scale operations in non-leather footwear? Will IT stocks keep driving markets higher? And what is the Mumbai Trans Harbour Link? Come July, and Australia's Deakin University will start admitting students. Now, this piece of news might not be interest to many, but what if we tell you that these admissions will take place in India and at the university's local campus in Gujarat? Well, you heard it right. Foreign universities are finally coming to India. The National Education Policy 2020 had laid down the framework, and UGC came out with a final set of regulations about 2 months ago. But will students warm up to foreign universities in India? Well, Abhijit Kumar has the answer.
It is the first foreign university to open a campus in India. Beginning July this year, Australia's Deakin University will offer two courses, Master of Business Analytics and Master of Cybersecurity, at its first offshore campus in Gujarat's Gift City. At another Australian university, University of Wollongong, too may follow the suit and open a campus in the Gift City soon. Founded in 1974, Deakin is a public university in Victoria, Australia. It was at the 233rd spot in Global QS World University Rankings. No Indian university made it to this year's top Global 100 list, but there are 6 between 100 and 300. The new UGC rules allow top 500 global universities or a foreign educational institution of repute to apply to set up a campus in India. The new rules also give universities the liberty to appoint professors and staff from India or from abroad. They are also free to frame their own admission guidelines and the fee structure too. These foreign universities are likely to give Indian students more options, and they may also take some burden off from the existing universities. India's higher education system has the third largest enrollment after China and the United States. In FY20, gross enrollment ratio was 27.1%. There were 38.5 million students enrolled. The total number of universities registered were 1,113, colleges 43,796, and standalone institutions 11,296. The National Education Policy now plans to double the gross enrollment ratio from 26.3% to 50% by 2035. But that may not be easy. More than 1 million students were chasing 17,485 seats in the IITs. Similarly, nearly 200,000 students appeared for 3,361 UG and 1,298 postgraduate CLAT seats for admissions to the 25 out of 27 national law universities. For NEET 2023, almost 2 million students appeared for nearly 200,000 seats across medical colleges in India. Clearly, India's tertiary education system is struggling to accommodate a large number of students. So will the foreign universities be able to bridge this gap?
What it definitely adds capacity to our existing capacity, what we have, where other people going out to some of the Eastern European countries or maybe going towards West for, doing their higher education. Are those facilities available in India? Yes, that of course is there. See, I think what really is the need of the hour is that how relevant the curriculums are, how much, are they integrated with the industry requirement, what are kind of industry micro-credentials that have been embedded into the programs which these universities have to program, and definitely what's the kind of pedagogy and the faculty that we're talking about. I think that's the critical ingredient for the any higher education institution to be successful or churn out job-ready people.
However, some experts differ. They argue that the foreign universities will cater to a limited segment of students and may not result in a notable improvement in the overall higher education system of India.
I don't think so, because the clientele or the students whom these foreign institutions will be catering to will be from the elite background, who are the paying capacity, who are from the better socioeconomic background. They are already in the colleges and universities, otherwise they will go to such institutions. So I do not combine this with the massification of higher education or extending enrollment of higher education to masses.
Education research firm CBERT says that as of March 2023, 39 countries had 333 foreign higher education institutions. Most universities in these 39 countries were from the US, the UK, France, and Russia, while countries like China and UAE had the maximum number of foreign university campuses. But there is more to it than meets the eye. Till 2020, in China, barring NYU Shanghai, no other foreign higher education institution was top ranked. In Malaysia too, not a single foreign higher education institution was ranked among the top 100 in the world. And back in India, a large number of students who aspire to study abroad have plans of getting absorbed in the foreign job markets after their studies.
There are two categories of students who are going abroad. One category of students go to United States, UK, Australia, Canada, that's 4 countries especially. So their interest is not only a degree from there, but also post-study visa and post-employment. So this is a high cost, high return pathway of Indian students going abroad. I don't think that they will be happy to go to an Indian institution located in India and get a degree, because their post-study employment opportunities are not going to be bright, especially the other category of students are going to Ukraine, the East European countries in general, and then China, etc. Their interest is not to seek employment there, get a degree from there and come back. So it's a calculation of the cost of education, but the purpose is not to stay. In both the cases, I don't think that the foreign universities will be in a position to resolve the issues of this motivation, this varying motivation.
Undoubtedly, allowing entry to foreign universities in India is a good move. Students will be able to get a foreign degree without leaving the country, which is a costly affair. But how many of them will come to India? Will they be top rated? While the initial NEP proposal was to allow only top 100 global universities, it was later tweaked to top 500. But clearly, a beginning has been made. It will be interesting to see if this initiative will help India meet the challenge of the shortage of quality education institutions.
While foreign universities may take some time to gain a foothold in India, footwear made on foreign shores have already made inroads here. Leather shoes and sandals have almost become invisible, replaced by cheaper non-leather stuff. The industry, it looks like, is on an inflection point as it is moving from the skill-based, labor-intensive leather footwear to scale-based, machine-led non-leather footwear. Clearly, it is a challenging time for Indian manufacturers. So, how can India scale up operations in non-leather footwear? Shivam Tyagi finds out.
Global footwear companies are shifting their focus from China to Chennai, and Tamil Nadu is emerging as a global center for non-leather footwear manufacturing. Taiwanese companies are now exploring opportunities to set up manufacturing units in the state. At the recently concluded Global Investors Meet in Chennai, 3 Taiwanese companies signed deals worth 3,200 crore rupees for setting up production units, particularly for non-leather footwear. It is expected to generate around 41,000 jobs in India. Suppliers of footwear giants like Adidas and Nike have also signed agreements with the Tamil Nadu government to set up similar plants. According to research firm iMark, the Indian footwear market was 15.1 billion in 2022. It is expected to reach 31.2 billion by 2028, growing at a CAGR of 12%. The growing interest from international footwear manufacturers in India and other Southeast Asian countries is part of the China Plus One strategy. China's share in the global footwear export is 61.3%. Southeast Asian countries such as Vietnam and Indonesia are ahead of India, which accounts for only 1.9% of the global footwear exports. Industry observers say India lags due to its minority production of non-leather footwear, which constitutes 85% of the global footwear demand.
The world expects more production of footwear from India, and since Indian entrepreneurs are not able to supply as per the world requirement, the multinational companies are coming and setting up the manufacturing unit in India. Due to China One policy, all the Western countries, they want to source at least 20% footwear from India. As I told earlier, current export is only 2%. So when they come to India, though, they are not able to find the right manufacturer in India. And they are bringing the manufacturers also to India. That is what's happening now.
India's domestic production is dominated by leather footwear. India exports 6% of the global leather footwear, while its share in non-leather footwear remains insignificant. Between 2022 and 23, India exported 45.2% of leather footwear. Non-leather exports accounted for only 5.4% of its total footwear export tally. Scaling up manufacturing in non-leather remains an uphill task for Indian footwear companies as they struggle with limited technology, higher input costs, and inadequate skilled labor for entry-level operations. Presently, India imports raw materials paying high import duties, leading to higher manufacturing costs. But neighbouring countries reap the rewards of foreign trade agreements with major markets like the UK, EU, and the USA. So, what's the way ahead for Indian companies to scale up their production and efficiency?
From the government side, what we need is to have a level playing field for India compared to our competition right now, which is mainly like Bangladesh, Vietnam, Cambodia. These are the main competitors that are challenging the China Plus One, opportunity, right? So they all have duty advantages, and India doesn't. Our government can come up with FTAs quickly. We will be at least on a level playing field, and we will be able to continue having that attractiveness to our clients.
India also needs heavy investment in research and development, developing molds, machinery manufacturing, and procurement of raw materials. Industry insiders believe the country will take some time to acquire these capabilities.
Currently, majority of the items, because mold, almost 90% mold is imported. So we need to set up more facilities in India. It may take some time, but when the manufacturing goes up, when this foreign companies also come here and set up manufacturing facility, the mold makers are also following. Some, because we need few international mold makers also, FDI in mold making also, machinery also. Currently, we need FDI in machinery manufacturing because currently we don't have that type of manufacturers in India. And another is raw material, especially petrochemicals, because ethylene vinyl acetate, polyurethane, many materials, we don't have sufficient manufacturing facilities in India. So government should work with private industries, petrochemical industries, and we should start manufacturing these materials in India.
The domestic firms also need a quick headway in technical expertise from the Chinese companies, say industry players.
When I say technology transfer, I mean expertise, technical expertise. It needs to happen fast and smooth. That is currently with the Chinese. Most of these technical experts are Chinese, They know how to operate those machines. We can't just buy those machines and expect to run it ourselves. We will need a little more relaxation on the current visa policies of our government to allow more Chinese technicians to be able to come in and to train our technical people.
India is the third largest consumer of footwear globally. It is poised to claim the top spot by 2030 with 90% of consumption in the non-leather sector. This offers an advantage for India to boost its synthetic footwear manufacturing. To capitalize on international demand, Indian footwear manufacturers must analyze global market needs and deliver accordingly.
Let us now see what is happening in financial markets. IT stocks have been firing up recently on strong Q3 earnings, sparking a rally in the overall market as well. The Sensex index has surged nearly 1800 points in just 4 sessions to cross a new peak of 73,000 on January 14. So, will the rally in IT stocks and the benchmark indices sustain? Harshita Singh finds out in this report.
The dream run of IT stocks into the new year has led to a remarkable rally in the overall market, driving the frontline BSE Sensex to cross 73,000 and Nifty above 22,000 levels. The Nifty IT index leaped 4% to its highest level in over 2 years on January 14. The strength in IT stocks came on better than expected December quarter earnings, which sparked bets that the worst for the sector may be behind. TCS beat expectations on both revenue and profit. HCL Tech led the IT pack with the highest growth rates in the top line and bottom line. Wipro's net profit dipped 12% year-on-year, but managed to be above estimates. Infosys revenue beat street expectations.
Parameters that reflected was better sequential revenue growth and improvement in margin led by better efficiency and productivity. Also on order deal front, most of the management talked about strong demand from artificial intelligence, general artificial intelligence and cloud as well as automation, and they believe that this will be the next phase of growth. Management commentary remained cautious for near term, but yes, not negative from a long term perspective. So that gives confidence for stocks to re-rate.
Those at JP Morgan on January 3 also upgraded their stance on the sector to neutral after being underweight for 18 months. They foresee the industry to clock sub 5% growth for financial year 2024, but expect growth to bottom out over the next few months until quarter 4 of FY24 and see acceleration during FY25. This, they add, will likely support expanded sector multiples and drive stock performance in calendar year 2024.
One can continue to add IT stocks in staggered manner, and in terms of valuation on FY26 basis, most of them are just trading near to its 10-year average PE, so there is still scope of upside.
The benchmark indices too, meanwhile, could continue to draw support from the current IT rally, charts suggest.
The BSE Sensex faces near resistance at 73,400 levels, above which it can jump to 74,300 or rally further higher to 75,500. The NSE Nifty seems on course to test 22,200. Support at 22,000 is crucial in the near term. Failure to hold the same can trigger a fall to 21,650. Among IT stocks, Infosys can rally to Rs 1880 with interim resistance expected at Rs 1740. Bias for Wipro to remain positive as long as the stock holds Rs 490. The Rs 540 to 550 range can act as a crucial hurdle. HCL Technology is trading at record high levels. The long-term chart suggests that the bias will remain positive as long as the stock holds Rs 1480.
Thus, bets of growth turnaround from FY25 could keep IT stocks in demand going ahead. Today, on January 16, stock-specific action will continue as investors react to the Quarter 3 result of Jio Financial and keep an eye out for HDFC banks.
He's making plans for an early retirement. Business Standard.
Meanwhile, India's financial capital got a big gift last week. Prime Minister Narendra Modi opened the country's largest bridge on the sea. The 6-lane Mumbai Trans Harbour Link will reduce the travel time between South Mumbai to Navi Mumbai to just about 20 minutes from the earlier over 2 hours. Vasudha Mukherjee has more on it. Over 45,000 people flocked to Mumbai Trans Harbour Link or MTHL on January 13th, a day after Prime Minister Narendra Modi inaugurated it. According to a report, till 9 pm on the day, over 9,000 vehicles used this 6-lane bridge, which is being hailed as an engineering marvel. This 21.8 kilometer long bridge, also known as Atal Setu, connects Navi Mumbai to South Mumbai and considerably cuts down the travel time from over 2 hours to just 20 minutes. This bridge was initially proposed way back in 1963, and after several proposals and setbacks, in 2017, the Maharashtra government decided to entrust the Mumbai Metropolitan Region Development Authority with this project. This bridge takes off from Sevri, South Mumbai, passes through Thane Creek, north of Elephant Island, and ends at Shirle village near Nava Sheva. It is strategically positioned to link key areas such as the proposed Navi Mumbai International Airport, GNPT Port, Mumbai-Pune Expressway, and the Mumbai-Goa Highway. Then there are interchanges at Shivaji Nagar, SH54 in Jasai, and Shirle on NH 348. The bridge will also connect Mumbai and Navi Mumbai to the Pune and South Indian Expressways. While travelling on the Mumbai Trans Harbour Link, you will cover 16.5 km distance above the sea and rest 5.5 km on land. The Sea Link has an additional emergency lane on both sides. The MTHL construction cost over 17,843 crore rupees. As of November 2023, 91% of the estimated cost had been spent on the project. This project comes under the Mumbai Metropolitan Region Development Authority or MMRDA, a consortium comprising ACOM Asia Company Limited, Pedico Co Limited, Dar Al Handasa and TY Lin International have served as general consultants on the project. The project was built in 4 stages or packages. Package 1 is the 10.3 km bridge spanning across Thane Creek and Sevri interchange. This involved intertidal and marine construction by L&T Limited and IHI Infrastructure Systems Limited consortium at the cost of 7,637 crore rupees. Package 2 is the 7.8 km bridge portion across Thane Creek and the Shivaji Nagar interchange. This was a marine construction managed by Devo Engineering and Construction Company Limited and Tata Projects Limited joint venture at the cost of 5,612 crore rupees. Package 3 is 3.6 kilometers of viaducts and interchanges that connect MTHL with State Highways 52 and 54 and National Highway 4B at Shirle. This land construction was also carried out by L&T Limited for 1,013 crore rupees. Finally, Package 4 is the Intelligent Transport Systems or ITS, including Toll and Transport Management System and Equipment Installation. This was constructed by Trabag Infrastructure and Safety Solutions GmbH and Strabag AG at the cost of 4,027 crore rupees. Mumbai, known for its dense population, grapples with congestion in local trains and public transport. MTHL will help reduce the travel time.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But some are finding the toll a bit costly. For a car, the one-way toll is 250 rupees and for the return journey it is 375 rupees. Monthly passes for cars will come at 12,500 rupees. Well, that's all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard.
For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.